Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and today we're going to be talking about gilt yields or bond yields and their relevance to the commercial property market. Now, you might be thinking, what on earth has this got to do with my investing? But actually, it's really, really important. And once you understand the correlation between gilt or bond yields and commercial property, in the UK at least, then you will start to be able to read the market a bit better than everybody else. And of course, that kind of knowledge can really help you and give you a competitive advantage. So first of all, let me explain, and apologies if you know this stuff, but let me explain what a gilt or a bond yield is. Now, the bond market is internationally and in the UK is lending to a government. So when we're talking about UK bonds, we're talking about lending to the UK government, US bonds to the US government, etc., etc. Now, that's how governments borrow to fund their investment programs and, you know, the spend that they necessitate on all kinds of things from highways to defence. And obviously, it's really important just as an investor overall to understand this market. You know, commercial property aside, if it's how our governments fund their spending programs, then it's really important to understand it. Now, one kind of slight peculiarity in the UK is we call bonds gilts, so they're called gilts in the UK, and we tend to look at 10-year gilts as our kind of benchmark, benchmark to commercial property, only because it's a longer term asset like commercial property is. So 10-year gilts is kind of what we're interested in. Now, governments borrow money by issuing gilts or bonds, and investors buy these gilts or bonds. Let's call them gilts for the rest of this podcast, just so I don't need to keep repeating bonds. But you know that they're the same thing in other countries. But investors buy these gilts for income or yield, so they will get a return on them. And bond yields or gilt yields move constantly depending on inflation expectations, government stability, economic stability, actually even international stability is really important, economic confidence, debt levels of the government, and interest rate expectations. That's why before a budget, when there's all the rumours, you know, before the Chancellor's budget, that's why you see all these kind of massive fluctuations in gilt yields, because it's the markets trying to price in risk and trying to understand what's going to happen. So when the rumour mill starts before a Chancellor's budget, you'll probably see gilt yields, you know, especially if it's negative, you'll see, and the markets don't like it, then gilt yields will go up, because if you're feeling less confident, you're going to want a higher return. So more risk, higher return, lower risk. So everyone's feeling great about the economy, great about the prospects for the future. And don't forget that, you know, I've done a podcast on this, that markets are run by sentiment. So it's how people feel. And, you know, part of a government's job is to make people feel good, make markets feel good, so that they will invest and, you know, not expect huge returns on the gilts. And, you know, when everyone's feeling confident, bond yields, gilt yields will fall. So if investors become nervous about government spending plans, about inflation, about, you know, global economic uncertainty, then they demand higher yields because it's higher risk. And higher bond yields also can mean that other asset classes can offer safer returns, perhaps, if everyone's feeling jittery about the government. Now, why are commercial investors so hung up on this? So this is what gilt and bond yields are. So why are we interested? Well, if you think about it, and let's kind of slightly talk a bit of theory here. It doesn't really matter how we are feeling about our current politics. It could be any government, any time in history where governments have been issuing gilts. But if you think about it, lending to certainly the UK government, US government, is seen as really the risk-free rate. So if you want to bung your investments in something that you think is going to be risk-free, you would probably choose gilts because you're lending to a stable government. Now, obviously, as things happen and time passes and governments change, markets feel differently about that. But as a kind of base case scenario, let's just work on the assumption that gilts are a risk-free investment because you're lending to the government. And it's relatively passive because you're putting money into the gilts. You will have it locked in for a certain period of time, whether that's a year, 2 years, 5 years, 10 years, whatever it might be. And then you will get your money back. Because actually what most investors are interested in, we all want to kind of return on investment, return on equity, internal rate of return. But actually what we're really interested in is getting our money back. And that determines whether something's risk-free or has got an element of risk associated with it. And so if gilt yields are risk-free, then other types of investments aren't. And certainly with real estate, with property, there are inherent risks. There's pretty obvious inherent risks. So you've got liquidity risk. You can't sell property. You can't just put it on the markets like you can with equities and get it sold within minutes or hours. There's a period of marketing that needs to happen. You might even need to get the property ready for marketing. And then obviously there's a process that happens thereafter. And actually with our sales system and our purchase system in the UK, then obviously that can fall over at any time, depending on how the purchaser is feeling, how the market is, the due diligence, etc. So you've got liquidity risk, you've got market risk, because markets rise and fall. You've got tenant risk and lease risk, because obviously you've got in commercial property, you've got tenants in there, you've got leases in there, and so tenant covenant. You've got property risk, which is the condition, is it going to fall down or is it going to stay? You've got rental risk, are they going to pay the rent? You've got sector risk of what you're investing in, so you've got locational risk, is there a big factory that's going to close, or whatever it might be. So you've got all these inherent risks in property, which obviously as investors what we do is we look to mitigate those as much as we possibly can. So when we're investing in commercial property, we want a premium on the gilt yield, because otherwise we bung our money into a risk-free asset. So therefore we want to get a higher return from our commercial investments, because there's inherent risk, and we're probably having to dive in and be more hands-on, and we're having to do our asset management or whatever it might be. We've got finance risk, because we've taken on debt or whatever it might be. We want a higher return. And so there's always often a premium on from gilts into commercial property. So that might be 2%, 3%, 4%, and obviously plus, depending on whether your property you're investing is low risk or high risk. So, low yielding stuff at the moment, kind of 5.5%, 6.5%. That's kind of assets that are long leases, blue chip tenants, types of sectors where there's seen to be some security and growth going forwards, up to 11, 12, 15, 20, 30%, depending on what the assets are, for much higher risk properties, because obviously we want a higher premium for properties that have more risk. So that's why after COVID, shopping centres went up to secondary shopping centres, some went up to 30, 35%, because suddenly a lot of the properties they emptied out. There was massive vacancy risk, tenant risk. Tenants, had to recapitalize after COVID because they lost a lot of money, etc., etc., etc. So, we have these low risk, low yield properties, and obviously a lower yield in commercial means a higher price because you're getting a low return, but you're having lower risk. You're having lower risk, and equally, if you have a high yield property, then you're getting a higher return, but you're taking on more risk. So high yield is more secondary, low yield is more prime. And so we become a bit obsessed by gilt yields in this market because what we tend to see is a correlation. So when gilt yields were at like 0.3% pre-COVID, what we saw, and obviously interest rates were very, very low then as well, and I'll come on to interest rates in a minute. Then we saw some commercial yields at like 2.5%. Now, on reflection, those seem incredibly high yields. But what happened? Low yields, well, kind of high prices. What happened after COVID is that, literally just after COVID, is that there was kind of a whole scale fear of retail. So a lot of the pension funds and high net worths and property companies that had kind of very retail heavy portfolios were kind of thinking, we need to balance our portfolios a lot. So a lot of them were piling into prime logistics, in London or elsewhere. And it was a very competitive market. And because gilt yields were so low, there was bidding wars, there was a lot of hope value in these purchases because these sectors were seen as kind of future-proof for the future. Land available for those kind of logistics operations in London is quite few and far between. And so you had to pay 2.5%, for example, to get hold of one of those kind of assets. But you could do that because there was, from 0.3% to 2.5%, there's a significant premium for the inherent risk associated with that property. Now, of course, what happened...
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
Post Liz Truss's budget, when the market got big jitters, everyone started feeling fearful about the government. And that's a great example of how that can literally happen overnight. One day everyone's feeling pretty bullish. They've got a new prime minister. Next day, they're very fearful because they feel like economic policy is wrong. They feel like the markets felt like Liz Truss was relying too much on spending, and that wasn't the right thing to do in the economy at that point. And so there was yield expansion. So what that means is that yields went up. So gilt yields had to go up, interest rates went up, and so therefore the commercial yields had to go. So almost overnight we saw the market drop because this kind of parity, this premium on gilt yields has to be sustained going forwards. So we are obsessed with gilt yields, basically, if gilt yields are still riding high, and as of May 2026, as I'm recording this, gilt yields have just last week gone over 5%, which is, I think, is the first time for, 20 years or something. They've gone over 5%. Then we are not seeing commercial property pricing dropping. And I think that's what we kind of forget, is that, everyone might be feeling great about the commercial market, but we need this parity between gilt yields and commercial property yields needs to be maintained. So the higher that gilt yields stay, don't expect commercial property prices to recover until, gilt yields start going down. And property has got a significant number of benefits over gilt yields as well. So this has to be weighed up has to be weighed up as well. Like the growth potential of property, especially if we're active managers, it can be significantly more than gilt yields. You would probably buy a property where there's a long lease, where there's not much to do for a low commercial property yield. But for high yielding properties, we can get something called yield compression, where we buy let's say 10% and we put a long lease in place, or we might refurb the property or do something to it to improve the value. We might get yield compression to 8.5%. That's how we can get longer term growth. And we might create an asset where actually we'd be happy to hold it long term, and we've actually reduced the risk associated with that asset through our active management of it. So that's one of the real benefits of real estate over kind of things like gilts. And over the longer term, actually, real estate in the UK has outperformed the gilt market because of that very reason. But there isn't this perfect relationship. I can't say to you, okay, every time gilt yields go down by 0.5%, commercial property yields are going to go down by 0.5%, or whatever it might be, or there will always be a 2% parity between the two, because obviously we don't live in a perfect world. We don't have perfect markets. There isn't perfect knowledge. So, this varies very much according to sentiment in the commercial market as well as sentiment in the gilt market. So commercial property is largely yield driven. So, the way we calculate commercial values is rent divided by yield. And that real yield, there's lots of different names for yields, lots of different types of yields, which I won't go into now. But, as a generic rule, we call that yield the all risks yield, because it reflects the bundle of risks that are associated with it. So, it's all very much about this risk return that we're looking at. So, if, as a general rule, always in the commercial world, if yields rise, then values fall, even if rents stay the same. And that's exactly what the market has actually experienced since 2022. That's exactly what's happening in the market. And of course, we need to bring interest rates into this as well, because as interest rates went up after COVID, then, that's been accompanied by bond yields rising sharply. There is a correlation there between the two. And, with higher borrowing costs as a result, and, investors demanding higher returns, therefore, and commercial yields moving out. So, as long as interest rates remain high, it's difficult to see gilt yields falling as well. So there is a correlation between the two. And, every sector in commercial property is different in terms of its yield, every type of property within that sector. So you take the industrial sector, which is massive. You've got everything from super prime distribution centres, regional, national distribution centres with 25-year leases to some of the major big brands in the UK, down to flex space where you're going to get 2 or 3 years. Nice, steady workshop type tenants, but, your yield's going to be significantly higher than it is with the prime stuff. So government stability really matters to property. So this is why, as commercial investors, we're really interested in budgets. We're interested in what's happening in the government. We're interested in our leadership. We're interested in leadership struggles, which is something as of May 2026. It looks like we're going to be going into that world soon, because markets hate uncertainty. Bond markets react very quickly to political instability. And the more that there is economic uncertainty, government uncertainty, both within the UK and internationally, the less chance there is of gilt yields correcting themselves, and therefore the less chance there is of the commercial property market bouncing back significantly. If actually, if bond markets struggle to stabilize, then commercial pricing really struggles to stabilize as well. So, commercial property pricing can't properly settle while the bond market is, still uncertain. And that's why we've been in a down market for the last 3 years, because interest rates have been high, bond yields have been high. And so there's been nowhere to go below a certain level for commercial property yields. So that's why when I see, all these reports from agents about how the market's going to recover this year, like all I'm looking at is bond yields. I'm looking at international stability. I'm looking at government stability, and I'm raising my eyebrows at the moment, thinking that's not necessarily going to happen. Now, this isn't all negative. In fact, it's far from negative, because there is opportunity hidden in chaos always. And so if you've listened to this podcast before, if you followed me, you'll know that I talk a lot about problems or opportunities. And I've been talking about the window of opportunity for the last 3 years. Why? Because it genuinely is, because prices are lower. So you make money in your lifetime in times where prices are lower. Now, if you've been trying to bid on something at the moment and you've looked at asking prices, you're like, what the heck is she talking about? And this is the interesting thing in this market right now, is that vendors are still, and agents have still got, I think, unrealistic expectations on pricing. So when you look at asking prices, don't base your offer in any way, shape or form on asking prices. You want to work out what you can afford to pay in order to make money on that particular asset. And, this is very much the market for forcing value through. You want to get yield compression. You want to be forcing that yield compression through your management of the property. So your buy price is the most important thing. And the best deals that I've done in my personal and in my corporate career are those where you've bought them for the right price. You've bought them at a price where you've got somewhere to go with your asset management. So these kind of times when there's instability is great opportunity, but we've been in a market now where prices actually should have been a lot lower than they have been. And that's because there hasn't been enough of a sentiment shift amongst vendors to match buyers' expectations. So that's why the market's been just a little bit sludgy. Stuff has been sitting on the market, or things haven't moved very quickly. There's only a couple of asset types where things are moving quickly. Properties with permitted development opportunities, definitely in the southeast, they are going well. Now, of course, you need to decide whether you want to be in the masses buying that, or whether you want to negotiate hard for properties that maybe the masses aren't quite so interested in, but I'll leave that up to you. And, I definitely see that there's going to be a sentiment shift amongst vendors over the next 18 months. I think that they're going to be coming under more pressure to refinance or sell. We're definitely seeing baby boomers kind of selling out of the market. And, but it's not a market to wait for big falls. Sophisticated investors, my clients, me, we're buying selectively. We're not just going to buy things for the sake of it, but if it makes sense and if we can add value, if we can buy for the right price, we will buy at the moment. And it's a fantastic opportunity. And I've got clients who've got £300,000 of asking prices, £150,000, £200,000. So don't think that those deals aren't out there. These are properties that have been openly marketed on Rightmove, in Allsops auctions. They are achieving these big reductions in asking prices. So, I think for the market to really tip into a world of opportunity, sellers need to become more motivated, but that's going to happen naturally through sentiment changes, through sentiment in the economy, both internationally and nationally as well. So, it's a really exciting market, I think, and it's far from being, we need to recognize problems, but far from it being a whole problem, it's actually a great opportunity in this particular market. So make sure that as a commercial property investor, you watch this gilt yield market. It's really, really important. Obviously, watch kind of how the markets are feeling, because it's a great indication of how markets are feeling. Watch, I read the commentary in a lot of the newspapers as well. I will look at what's happening internationally, because that obviously we're so interconnected as a world right now. Obviously, watch interest rates and base rate expectations and swap rates as well, because obviously that's a sentiment play too. Lending margins, transaction volumes, how long things are sitting on the market for. Definitely institutional sentiment at the top of the market, because these are very sophisticated investors investing in the lower yielding commercial properties at the top of the market. And definitely occupational demand. And this is another area where governments can influence it, because if governments make businesses are commercial property tenants. That's the very definition of commercial property. If businesses are feeling optimistic, if their prices are going down, they will be up for taking longer leases, paying higher rents. But as we've seen over the last few years, obviously there's been sectoral shifts because of, things that have happened with COVID, etc., offices and retail in particular, but also, national minimum wage going up. We've had national insurance for employers going up. We've had pension changes, and all of that, energy rises, business rates going up. All of that is making business more jittery. So if you're feeling jittery, just like a consumer, if you're feeling jittery, you're not going to go out and splurge on a big night out, or a new outfit, a really expensive new outfit, if you're feeling jittery about whether you got money coming in. And equally with businesses, they are the same. Investment reduces. And so the government's desperately trying to get businesses to invest, but they're taking away, and increasing their costs, which make businesses more jittery. So, bond markets might sound boring. It might seem irrelevant to commercial property, but it's so important. And it leads on, as you've kind of heard me talk about, to numerous other factors that we need to we need to take into account. So this is something that I watch really carefully with my clients. I report back on the bond market very frequently, the gilt market very frequently, because it's so important. And it affects pricing in the commercial property market. So we're really interested. So thank you for joining me today. I really hope that has kind of given you a new light on commercial pricing. It's going to be a really interesting market over the next 18 months to 2 years. And I definitely think the window of opportunity is going to get wider and wider. And obviously that is just opportunity. So make sure you're in cash if you possibly can, or have got finance arranged. You're very clear in your strategies, which is what I work with my board members on. You're making sure they're absolutely crystal clear on their niche so that they're basically ready to go. And then don't wait. Selective deals can absolutely, be not incredible deals at the moment some of my clients are doing. So it's not necessarily a market to wait. It's a market to buy well. And that is the big difference. So thank you for joining me, and I'll see you next time.